Oh, the times they are a changing. Right, I promise you that's the last time I'm going to sing because I cannot sing. Right, we're going to do a portfolio update because I got some significant changes coming in my portfolio over the course of the next few days as I plan for 2026. Keep forgetting what year it is. Right, first of all, let me get it up because we're at a time where I've reached a new milestone. Here it is here. So that milestone is I've reached £150,000. Now, I went over that yesterday. January started really well. Last year, over the course of last year, let's have a look. £21,000 up, 17% up. So it's absolutely flown. It has been a phenomenal year over the course of the last 12 months, despite a 40% crash in April. Now, there always is going to be crashes. That one we recovered from very quickly. The next one we might not. No one knows. So let's go over the portfolio in the first instance, and then I'm going to explain what the changes I am going to be making. So over the course of last year, one 1 year, 17% up, £21,000 up. Over the course of the last month alone, 1.8% up. That's 2,700. Now, because my portfolio is now at £150,000, any changes in the market are significant, right? They're significant in terms of what it does to my portfolio. I started with £20 in January 2020. I upped my deposits from there, obviously, in order to be able to achieve this portfolio now. And there was a couple of years where I maxed out my ISA. I don't know whether I'm going to be able to do it this year, having been made redundant in April, as you all know. So let's go over the portfolio and look where we're at. So there we are, see. £15,000 now deposit into the ISA with 4,300 left. Now, if I can bridge that gap, I have to manipulate some money here and there in order to be able to make that happen. I will do it, but I'm also looking at using a couple of other ISA providers as well, just to make sure that I've got one, knowledge across the different ISA providers so that I can share my experience with you guys on it, and two, just to have something else to play around with, because I'm a victim of checking my portfolio every single day, multiple times a day. I know it's not the right thing to do, but it's what I do. So I want to have other places to check as well to keep me busy. Now, trading 2 and 2 have updated the way that it looks, and it hasn't gone down well with a lot of people. Let me know what you think below. A lot of people are very frustrated with how it looks now. Basically, in order to see all your positions, you just need to press see all. So the biggest position in my portfolio always will be the Invesco All World FTWG dividend paying. Dividend paying isn't right for everyone. Most people should probably get an accumulation one, because during your wealth generation phase, what you want is it to be hands off, completely admin free. 50% of my portfolio, 49.6% of my portfolio is made up of that all world. Now, the first thing that I want to do is significantly increase my allocation into that. I think that I am taking more risk than I am comfortable with at the moment, by having such a range of different investments. For anyone that hasn't seen the channel before, I started it 4 years ago to track my journey to financial independence, and I'm aiming to achieve that by the time that I am 50. That now is 8 years away, right? From the 14th of February, that's going to be 7 years away. I am a Valentine's baby. The second biggest position I have in my portfolio, 27%, 26%, is in the S&P 500. That is up 38% since I started investing into it. I did change the fund that I was using a couple of years ago, so it doesn't fully represent the gains. Same with the All World. Both of them I'm up much more than is actually shown here. And when you add together the All World and the S&P 500, that represents 75, 76, 77 nearly percent of my portfolio. I hope my kids didn't hear that. They'd be all over it with their stupid little hands. Right, the next one I have is iShares Nasdaq US Biotech. So I went into Biotech a number of years ago after reading so much of Andrew Craig's stuff. So, it is, with modern day content creation within finance, it is very easy to be influenced. And I was influenced by that. Now, in reality, that's not what Andrew was trying to get at all. He was trying to get at the point that biotech, UK businesses, and in general, he believes in decades' time will have significant growth, not the BTEE Nasdaq, not Nasdaq yet, Nasdaq US Biotech Fund. So I'm going to be selling out of that. That one's coming out. That's the first big change that's going to be coming. I've only got 5,600 in there. It's a lot of money, I know, but in terms of percentage of my portfolio, just short of 4%. It is up 32%, but that mainly is over the course of the last year, yeah? So prior to that, I was in the red for a number of years, so it has come good. Lloyds, I have a small position in 2.7%, but it is double the position that I wanted it to be in because of the growth within that. It is absolutely flown, 100% up over the course of the last year. Now, that is because interest rates have gone up so much. Of course, we know this. Banks in the UK have done phenomenally well over the last 12 months because of interest rates. Now, the interest rates look like they're starting to be on the decline. What impact that will have on Lloyds remains to be seen. That one I'm actually going to be keeping. Now, all of this isn't confirmed 100% in terms of changes I'm going to be making, but it gives you an indication of the stuff that I'm thinking about. Legal in general has gone into the green for the first time in a long time. That's because of a 17% gain over the course of the last year. So 17% gain, as well as, let's get down here, an 8% dividend. So it's done really well for the similar reasons as Lloyds Bank, to be honest with you. That is 2.6% of my portfolio as well, similar to Lloyds. That's one that I am going to be keeping going forward. Google, 172% up. This is one I'm going to be trimming quite a bit. Now, if you listen to the likes of Peter Lynch, he talks a lot about the fact that let your winners run. Don't necessarily sell out of your positions when they're flying, because they could go up even more. I don't necessarily take that approach. I do to a certain extent. So over the course of the last 12 months, I've sold out of Rolls-Royce, which was 800% up, and that has since gone up another 25%. And I've sold out a Tesla, which was a 10 bagger for me. That was the first 10 bagger. Anyone that doesn't know, that means it's 1,000% up. It's 10-folded on my return. I only started with a few £100 in March 2020, but those returns have been so good, I banked them, and I wanted to bank them. Now, what I did with the cash from both of those is I sold it massively up. I took that money and I put it into my old world. Now, if I can do that a few times over the course of my investing journey, what's going to happen is it's going to increase my returns on my old world, if you like, on my portfolio. Now, as a result of having taken that approach since I started, the average return I've had in my portfolio since January 2020 is 19% per year. So I have significantly beat the market, but I do not put that down to skill or ability. I put it down in large part to luck. I am aware enough, self-conscious enough to know that a large part of that was luck, a large part of that was consistency and staying within it when it was hard to do so. 2022, for example, the market went down significantly. A lot of these businesses, there's a lot of green here, there was a lot of red back then, but I kept hold of them and I kept going. So Alphabet, Google is going to get cut significantly. How much is, I haven't decided yet. Once I have decided all of these changes and I've implemented them, I will come back to you with an update. Microsoft, 55% up. That is 2.35% of my portfolio. Now, another thing to bear in mind is with Microsoft and Alphabet, having nearly 5% in both of those and the S&P 500 and the all world means I'm very highly exposed to Alphabet and Microsoft. Now, I've always mentioned that I've been comfortable with it, but I'm not so much anymore because of the reasons I mentioned, getting closer to retirement age at 50. I want to be consolidating some of this sort of stuff down. So both of those are going to get trimmed. Realty income, 10% down now. What a bugger. What a bugger of a position that's always been. I bought that because I wanted exposure into diversification into property in the US. It has given me that diversification. It has underperformed for me. It is in the red, but it's something I'm comfortable with. Aviva is 45% up. That's one of the first businesses I bought as well back in March, April 2020. I bought it in Hargreaves Lansdown. I think I was about 40% up in Hargreaves Lansdown when I sold it and moved it across into trading 2&2. So I probably doubled my money in Aviva, and it is a tasty dividend as well. It comes in at 5.41%. So growth and dividend, US relatively stable business. It's one I'm comfortable to hold. Apple hasn't had quite the year that some of the other giant tech businesses have in the US. It's up 6.5% versus, I mean, the old world. What was it up? Let's recheck it. In the last year, the old world was up by 13.9. So the old world has doubled the returns versus Apple. So that one is a smaller percentage, it's 1.61, because I halved it maybe a year ago when I was about 100% up in that. Again, took the money out and put it into an old world. Yet to decide what I'm going to do with that. I do love Apple products. I do love the business, the model. They're very highly valued company. However, is that too much? I don't know. We'll see. Unilever. This is 1.5% of my portfolio, and I'm just short of 5% up. It's one I'm relatively comfortable with. Over the course of the last year, it is down 7.5% though, but it is a dividend payer, 3.68%. And for the long term, some of these businesses, what they do is they give me exposure into specific different things. So I don't have much UK exposure. That gives me UK exposure. It gives me consumer goods, which sometimes are recession proof because everyone needs consumer goods at some point in their life. Doesn't matter if we're in a recession or not. So I'll think about that one. Invesco, EQQQ, NASDAQ 100. So the top 100 tech businesses in the US. That one's going to get trimmed, if not completely sold. 10% up. I used my money from Pepsi to buy that because I was just had enough of Pepsi. I sold out of Pepsi. Bought the NASDAQ in the last 5 months, and that's returned 10%. Not going to discuss that one because I'm not allowed to. Virgin Galactic, 90% down. I will always keep that. I will always keep that as a reminder of what it was like in 2020 and not to be an idiot. Amazon is part of the RoboPie I did, as well as Uber, as well as Nvidia, as well as Meta. So I'll do a separate video on that, but basically I used AI to give me a portfolio to see how it would perform versus the S&P 500. It has absolutely tanked versus the S&P 500. I thought it would. I hoped it would in reality. So listen, the key thing here is that this is the last time you'll see this portfolio looking like this. In the coming weeks, when I do my next update, it's going to be trimmed much more. We're going to have much more of an allocation into the old world. Now, I don't know what the market's going to do over the course of the next year. It could be that that's a terrible decision and all of those businesses absolutely fly. But once I make a decision, like I did with Tesla, which has gone up since I sold it, like I did with Rolls-Royce, I am committed to it and I don't look back and I don't get annoyed at my decision, because I know that when I'm selling it, it's going into an old world and it helps me just sleep that bit easier. It is very difficult to pick stocks that are going to get the gains that I have seen so far going forward. And I don't believe that I am someone that can do that. I do believe that very, very, very few people can. I have enjoyed tinkering around with these, and I will continue to do so with smaller amounts, so long as my old world is much bigger. That's the aim, because effectively this is my retirement fund. And that is around the corner. Listen, when I do these updates, I get a lot of, not criticism, but observations in terms of my portfolio and what you would have done differently, what other people would have done differently, how completely mad I am to choose what I've chosen, my duplication, all sorts of stuff. So let me know what your thoughts are, but that's what my plan is going to be, and I'll keep you updated. Now, don't forget, if you haven't already started with Trading 2 and 2, you can get a free fractional share if you use the link below or promo code Neil. Right, take care. I'll see you soon. No more singing.